Good day, I am Mary Rose Swan and I will discuss to you the determination of exchange rates, forecasting exchange rate movements, and implication of exchange rate changes. Determination of exchange rates. Determination of exchange rates is a fixed or peg rate is determined by the government through its central bank. The rate is set against another major world currency. To maintain its exchange rate, the government will buy and sell its own currency against the currency to which it is pegged. What are the determinants of exchange rate? Here are the factors that affect currency exchange rates. Number 1 is inflation. It is the relative purchasing power of a currency compared to other currencies. As such, countries with low inflation typically have stronger currencies compared to those with higher inflation rates. Inflation is the rate of increase in prices over a given period of time. Inflation is typically a broad measure, such as the overall increase in prices or the increase in the cost of living in a country. Next is interest rates. These are tightly tied to inflation and exchange rates. Different countries' central banks use interest rates to modulate inflation within the country. Number 3 is public debt. Most countries finance their budgets using large-scale deficit financing. In other words, they borrow to finance economic growth. In general, it has been felt that debt financing is appropriate when the tax burden of a current financing for certain circumstances would be practically or politically infeasible. Examples are for national governments, war, and for local governments, large capital projects such as highways, schools, and so on. Next is political stability. A politically stable country attracts more foreign investment, which helps prop up the currency rate. The opposite is also true. Poor political stability devalues a country's currency exchange rate. Economic health. This is another way exchange rates are determined. With a strong economy, the country attracts more foreign investment, which in return helps lower inflation and drive up the country's currency exchange rate. Balance of trade. It is the relative difference between a country's imports and exports. In such a case, the inflow of foreign currency is higher than the outflow. Balance of trade. The difference in value over a period of time between a country's imports and exports of goods and services, usually expressed in the unit of currency of a particular country or economic union. Next is current account deficit. This is closely related to the balance of trade. In this scenario, a country's balance of trade is compared to those of its trading partners. Current account deficit is the shortfall between the money received by selling products to other countries and the money spent to buy goods and services from other nations. Another is confidence or speculation. Sometimes, currencies are affected by the confidence traders have in a currency. Currency changes from the speculation tend to be irrational, abrupt, and short-lived. Government intervention. Governments have a collection of tools at their disposal through which they can manipulate their local exchange rate. Primarily, central banks are known to adjust interest rates, buy foreign currency, influence local lending rates, print money, and use other tools to modulate currency exchange rates. Government intervention is regulatory action taken by government that seek to change the decisions made by individuals, groups, and organizations about social and economic matters. Let's now proceed to forecasting exchange rate movements. In the medium term, movements in an exchange rate reflect things like changes in interest rate differentials, international competitiveness, and the relative economic outlook in each company. On a daily basis, exchange rate movements may reflect speculation or news and events that affect the respective economies. Purchasing power partly looks at the price of goods in different countries and is one of the more widely used methods for forecasting exchange rates due to its indoctrination in textbook. The relative economic strength approach compares level of economic growth across countries to forecast exchange rates. Implication of exchange rate. When exchange rates change, the prices of import goods will change in value, including domestic products that rely on imported parts and raw materials. Exchange rates also impact investment performance, interest rates, and inflation, and can even extend to influence the job market and real estate sector. So, what happens when exchange rate increases? If the dollar appreciates, the exchange rate increases, the relative price of domestic goods and services increases, while the relative price of foreign goods and services falls.